Hello and welcome to the Finance Quarter. I'm Andrew Robertson. House prices in Sydney and Melbourne in particular have had a spectacular start to the year and are showing no signs of slowing down. Well, that's okay if you already own your own home, but if you're a potential first home buyer, getting into the market is an increasingly daunting prospect. So what can you do when prices seem out of control? Well, Sydney-based financial planner Damien Cullen believes those wanting to buy their first home may have to ask themselves some difficult questions. Damien, with median house prices in Sydney and Melbourne now around $600,000, many first home buyers or potential first home buyers are thinking to themselves, how can I ever get into this overheated market? I mean, what's the answer?
The answer is you've got to do what your parents did. You've got to save hard. You've got to be prepared to compromise. A lot of people, when they move into a house or want to buy a house, want to buy around the suburbs where they grew up. But most of the suburbs in the major cities, of course, those suburbs have become more affluent over the decades that this generation's grown up. So you've got to do what your parents did, move out to areas that are probably less affordable, buy a house that you can afford, get your foot on the ladder and start to work your way up to something that in time will be a more affluent area as well.
There's a real sense at the moment too that people want a lot more from their houses. They want a bigger house in a better location with a lot more in it than their parents did. I guess that all costs money, doesn't it?
Yeah, everything costs money. The more you want in your house, if you want a lock-up garage or you want the fancy kitchen, all those things do cost more money. And at the end of the day, they've got to be paid for. So it's a matter of how far you want to stretch yourself and what the compromise is between getting into a property and having the ideal property. Maybe the ideal property is the second or third property, not the first one.
So in very simple nuts and bolts terms, you've got a young couple thinking, I can't afford to buy. What's your advice to them to get into the market?
You've got to look at why you're buying the property. If you want to buy a property because you want to have an investment, then look at alternatives. There's the share market. There's lots of places you can invest your money. If you want to be living in a property, then you've got to look at your expectations. Maybe you move out to a cheaper area or buy a smaller house without all the extra bits in it. If you're just in a pre-buying stage, then you should be at least putting away as much money every month as what you'd normally be paying on the repayments for the property you expect to buy. If you can do that for a consistent period of time, then you know you can afford that debt.
So I guess if you're going to save money and put it aside to buy a house, that means you're probably going to have to make some lifestyle choices now on what you spend your money on so you can actually get that money together.
That's right, yeah. Every dollar you spend today is a dollar that you don't have tomorrow for your house or other investments that you want. So when you're looking at buying cars and phones and iPads or going on holidays, that's all money that you're really going to be worth nothing down the track. So all those things that you take up today, they're going to cost you down the track. So you've got to make those decisions as to what's more important to you long term.
Damien Cullen, thank you very much for that advice.
My pleasure, Andrew.
Now, one of the reasons house prices are rising so dramatically at the moment is because so many investors are in the market. The only reason you invest, of course, is to make money, but it's surprising how many people pour their own hard-earned money into investments without properly checking out the ability of those investments to make lots of money. Matt Sherwood is the chief economist at investment house Perpetual, as well as being the author of this book, Intelligent Investing. He believes what many people call investments are little more than gambling or speculation. Matt Sherwood, why do you believe that many people who think they're investing are actually just speculating?
Well, when you think about investing in companies, whether they be private or public, it's very important to actually be thinking about what you're doing. And when you invest in a private company, like you open a news agency, you don't sell 3 magazines and then look to dispose of the asset. You actually the idea of starting a company is to employ some people, earn a profit year after year after year. And so I think that investing in a public company should be, along the same lines. You're there to enjoy the dividend income year after year. And so those who buy and sell companies very quickly, to me, aren't there to enjoy that. So to me, they're not investors, they're actually speculators.
So it's that income stream, the dividend yield, that you should be focusing on?
That's correct. And the time frame, the duration. I mean, investing is not a sprint race. It's a very, long and slow marathon. And really the key is to be holding companies in your portfolios that not only pay a dividend, but the dividend actually increases through time. And that's obviously driven by investing in companies who are growing their earnings through time. And that's actually important because it actually allows that spending power for that income to actually rise at a faster rate or the same rate as inflation. So you can actually maintain your spending patterns rather than having it corroded away by inflation.
You often hear people say things like, this share has fallen a long way in recent times, it must be good value, if I buy it now it's going to recover, I'm going to do really well. And what's wrong with that approach?
Well, sometimes you have to be very careful about trying to catch a falling knife. So a lot of companies have low share prices for a reason, and that is that the earnings capability has actually been depleted, it's been eaten away by competition, or the simple fact that the corporation's not doing very well. So just looking at the share price in its isolation is probably a too simplistic approach. What you need to look at, of course, is the share price as well as the earnings capability. And there's no doubt that markets, at least in the short term, can oversell really high quality companies. And of course, they represent terrific buying opportunities for the patient investor. But really, investors have to also be very careful about not purchasing a company whose market share, whose earnings and whose dividends are probably more at risk. So it can be a dangerous game, but it can also be a very rewarding one. And the key there is focusing on quality operating models and quality balance sheets.
I mean, I guess in the Australian market at the moment, there's some very high-profile examples of companies whose shares are cheap and have been, or cheap in inverted commas, and have been that way for a long time, like Qantas, like Billabong, like AMP, and there's really no hope in the near future of them, those share prices going up. So that is a warning that just because it's cheap doesn't mean it's good value.
And that's exactly right. And the key then is trying to understand why the share price is down. If it's just been sold down because the market's heading down, and you look at the company and think, well, the earnings outlook looks quite good, then of course that represents an opportunity. If it's going down because it's losing market share, it's losing margins, management's left, there's a management hiatus, its balance sheet's weak, then of course that's a real indication of risk. And so one of the real arts of funds management is actually determining the difference between risk and opportunity.
Matthew Sherwood, thank you very much for your time.
Right, thanks very much, Andrew.
Nearly all businesses that thrive do one thing well, and that's innovation. And with parts of the economy in the slow lane, the ability to innovate could be the difference between not just thriving, but surviving. Sadly though, business consultant Dr. Ken Hudson believes many businesses have lost the ability to innovate just when they need it most. I asked Dr. Hudson why he's reached that conclusion.
Well, I think there's two big reasons. One is it's just hard, it's just difficult. And involves things like expenses, it's time consuming, but most of all it involves failure, experimentation. And it's hard to get managers and leaders and business owners to actually say, hey, I'm going to be innovative when they could run the risk of failing. So that's one big reason. And the second reason is a paradox, is that if they've been successful in the past, sometimes they're unwilling or unable to change in the future because they'll say, well, it's worked in the past, it'll always work.
What do businesses lose when they stop innovating?
Well, for a number of very important things. One is the trust of retailers, for example. Retailers are actually pushing companies to be more innovative. Consumers now expect it. You only have to look at the latest releases of the Apple products, for example. The consumers that want the companies to be more innovative, and they also lose the ability to charge higher margins, and then they only really compete on price. So it's a sort of a downhill spiral.
How do you know if you're not innovating?
Look, I think there's three questions any person has to answer when they're wanting to innovate. One is, what does innovation mean in your business? Exactly what does it mean? How do we measure it, and why do it? And I think the second one, how to measure it, is probably the most important, because that's the only way we'll really know if a business owner or business manager or leader is winning or losing is by having some kind of metrics in place. It could be new product sales, it could be customer satisfaction as a de facto measure, or revenue growth. But you've got to have some measures in place, otherwise you can spend a lot of money on it without much return.
Well, for business owners watching this who may be thinking, having heard what you've said, oh, maybe I'm not innovating or not doing it as well as I should, what are some practical tips to become an innovator?
Well, I think there are a number of things you can do. My favourite tip or tool, if you like, is to, every time that you come across a problem, a challenge, an opportunity, is that you think of 3 different responses, 3 different sets of ideas. A usual set of ideas, a different set of ideas, and a radical set of ideas. So that's a very powerful tool to help you open up your thinking. I think that's one good thing. I think the second one is not to discount your own experience as a customer or consumer. You know, if your experience is a frustrating one, then maybe other consumers feel the same way, and maybe that presents a new opportunity for you. You know, talking to your users regularly, talking to your employees, your team, your staff, keeping an eye on your competitors. There's lots of wonderful, get actually very focused. I think that's another really good tip. Steve Jobs would talk about, look, we're only going to do 1 or 2 or 3 things, and I think that's good advice to any would-be innovators, not to do lots of stuff, but maybe concentrate on 3 things that you could make a real difference to a consumer's life.
You alluded to it at the beginning of the interview about businesses doing things this way because that's the way they've always done it.
Yeah.
To change and to innovate, though, you'd want to see a real benefit from it. So what is the benefit to a business from becoming an innovating business?
Yeah, I think the biggest benefit is just, I think 2. One is just that they'll stay in business. And you only have to look at examples like Kodak, for example, that didn't innovate and they're no longer in business. You stay in business and you prosper and you grow. I think that's from a financial point of view. But from an employee point of view, which I think was equally important, is that increasingly the best and brightest people want to work with organisations that are creating, that are innovating, that are trying things, that are testing new things, that want to do things differently from what it's always done. So I think that there's a financial benefit and I think there's a great people benefit.
Dr. Ken Hudson, thank you very much for those insights.
Andrew, my pleasure.
Well, that's all for this edition of the Finance Quarter. As always, if you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. We're also on Twitter at the address on your screen now. Thank you for watching, and we'll see you next time on the Finance Quarter.